Hey guys, All in Crypto here, and welcome back, ladies and gentlemen, for another YouTube video. This is going to be our daily cryptocurrency market update, and we have a lot to get through in this one. I'm going to be sharing some data with you that you guys can make your own mind up on. Some pretty huge data, actually, in regards to some of the biggest financial players out there and what they're doing right now. And of course, relate that to the cryptocurrency market. Just to reiterate, my overall view is that the pain is not over for the cryptocurrency space. And the broader risk on asset classes. We've done a lot of things. The video that we put out yesterday, we looked at the money supply. We've looked at what interest rates typically bring. You know, markets, there's not evidence to suggest that this is going to be the start of the bull market. At the end of the day, nobody really knows when that's going to be. But from a technical point, you know, this does not look like bottoming structure. Fundamentally, I don't think there's going to be the money to sustain this kind of a rally, certainly when liquidity is being taken off the table, not actually put onto it. And we've got a restriction in the money supply, among a whole litany of other things. So we're going to really start things off by looking at this tweet from Gavin. Larry Fink, the CEO of BlackRock, which is the world's largest asset manager with over 10 trillion in assets, sold another 8% of his own stock last week. This is his biggest stock sale after the pandemic. His last biggest stock sale was right before the March crash. So you can see that this is pretty interesting, because why is Larry Fink doing this here? And you can see where his sales actually are. So he sold this month, essentially. This is you know, pretty darn interesting that he's doing this, to be honest. Because why is he doing this? He's done it essentially on the 3rd. So he did it last week at some point. Extremely interesting. And remember, the last time that he did this was before the March 2020 crash. I can't help but feel, and here's what markets love to do. They are evil in many ways. What they will do is change the sentiment, have everybody flip bullish, only to pull the rug from under your feet. That's what markets do, typically. What they will do is they'll take money from the educated, or the uneducated, I should say, and give them to the educated. You know, and there's loads of other parables out there. But why is Larry Fink selling 8% of his shares here if he thought this rally was going to continue? He's not selling his shares because he thinks they're going to go up, selling them because he thinks they're going to go down. Probably trying to preempt what is on the table. This was an article. You can see the individual's name up here. I'm not going to try and pronounce it. It says sell everything. Hedge funds are betting against bonds and stocks. This is sell everything. Hedge funds are bearish. Bets are mounting on both stocks and bonds. This is the leverage fund net S&P 500 E-mini futures position. And you can see very aggressively ticking to the downside. And also the leverage fund net aggregate Treasury futures position is also ramping up in people speculating that there's more downside on the horizon. And there certainly is the potential for that, in my opinion. You know, I ultimately think that we put in new lows. I think we have a final stab lower, if nothing else, if that isn't more of a long drawn out thing. But it's really interesting to see the likes of Larry Fink and all these other hedge funds actually, you know, bet against this rally. So in regards to today, the stocks making the biggest moves in the pre-market. You've got a number of big companies that are actually coming out today. We've got the CPI print, by the way, on Wednesday, everybody. I should have already started with that, but that's going to be interesting. I think we're going to get a lower CPI print. I think it's going to be ironic if markets sell off on a lower CPI print. Because, you know, what it essentially shows is, all right, maybe inflation is peaking. The issue is that even a 9.7, I think, is a consensus, is still ridiculously high. And if it comes out even hotter, oh boy, certainly after the non-farm payroll numbers that we got, you know, the Fed has every single mandate and reason to continue on their kind of regressive monetary policy cycle that they're currently going through. Interesting tweet here from Macro Alf. After creating over 1.5 million jobs since 2010, Amazon cuts its workforce by around 100,000 people in the first quarter of 2022. Amazon reduction affects 6% of its headcount and is by far the largest cut in a single quarter in history of the company. So lots of people are saying, okay, well, this is because things are becoming robotic. we believe that there's going to be a cascade of layoffs. You've got to remember, going into, I think, the 2008 financial crisis, you had a similar non-farm jobs payroll report. I mean, if you look at the labor force participants, it's not back to pre-March 2020 crash levels, yet the job numbers are. So there's something going on there. Are people having to take 2 or 3 jobs to pay their energy bills, which leads us on nicely to this tweet here. Energy bills are spreading around German Facebook. Starting by October, the bill will cost 1,175 euros instead of 210 euros per month. So this is just simply unaffordable. We watched that ITV clip that was essentially talking about in Britain, you know, starting in sort of September, October, and bearing in mind right now we're in the winter months, the summer months, so your energy bills aren't naturally going to be more expensive. But going into that winter, you know, these are costs that are simply going to be unaffordable. I think ITV gave a figure of around about 10 million UK citizens will not be able to afford their energy bills. That's startling, and that's a reality that I think we are going to have to face. And you've got to ask yourself, the real question here is, okay, well, how are markets going to fare in that kind of an environment? The answer for me is I don't think they fare very well. Again, taking liquidity off the table. Not are we seeing it taken off the table from a monetary standpoint, but we're also seeing it getting taken off the table from a kind of what's the right word? Retail standpoint, in regards to people can't, you know, afford their own bills, let alone putting money into markets. And it's a very different environment from the one that we were in from March 2020 onwards. March 2020, I keep saying this, is going to be extremely significant in our history. It's going to be almost an event-ending day. And here's another thread looking at, you know, prices and just how much they've actually inflated by, whilst they're essentially telling you that inflation is you know, 10%. I think it's significantly higher across the board. I know Germany has a real increased CPI. This is having spoken about the Treasury yields, so the bond market, the 1-year US Treasury yield has moved up to 3.29%. Its highest since December 2007. Only 14 months ago in June, it hit an all-time high or an all-time low of 0.04. So you can see people are running to shorter treasuries over the long ones. That's why we have this yield curve. This typically signals more downside. And that, to be honest, I think looks very likely. I think downside looks exceptionally likely, actually, across the board for your asset class. Does that mean that I'm bearish on crypto long term? Absolutely not. Nobody's more bullish than I am. If you haven't seen my video on Wells Fargo's report titled "Digital Assets: A World of Possibilities," make sure you go ahead and give that a read. It talks about, you know, this internet of value that the cryptocurrency market is, and how it's very much akin and similar to the car revolution, so the motoring industry or the telecom industry, or even electricity is what it compares it to in terms of a technological revolution that's going to change the world. I just think we have, looking at things from a kind of broad perspective, more pain to come. You know, 2008 was the last recession. Bitcoin hasn't seen this kind of an environment. What happens if we end up in a similar environment to 2008 or prior to that? I don't think that they're markets that, you know, they're conditions that allow markets to flourish, which is why I think bottom callers are ultimately going to be wrong. And you've had the same bottom callers, by the way, that have called here, all this, you know, oh, here, and now they're calling it here. The track record speaks for itself. You know, we weren't the first out of markets. We were around about your 44K range, but, you know, it essentially went to 17. So you know, very happy with that decision with hindsight in my favor. So that's really all I've got for you in this one, guys. Very interesting about Larry Fink selling his stocks. Last time, again, he did this was before the crash of March 2020 to this degree. And he's also now offloaded a lot more. Why? He's not doing this because he thinks that things are going to go up. Okay, so if he thinks things are, this is a good indicator of the direction he thinks markets potentially are broadly going to go into if he's selling his own stock. So that's all I've got for you in this one, guys. If you've enjoyed the content, a like is always appreciated. So is a comment, and I look forward to seeing each and every one of you in the next YouTube video. Have a fantastic Monday, guys. I'll catch you in the next one.